This is part 4 of our Chapter 4 video lecture series. This should be the last part where we're going to be covering adjusting journal entries and closing entries, this time for a merchandising versus a service type company. But before we take a look at that type of journal entries, let's review the steps for recording transactions of a merchandising company. Keep in mind that all of these PowerPoints I'm showing you, you can download the file and even exercise PowerPoint files in our Laulima chapter resources folder. Let me illustrate the cycle on my own screen here using this blank paper. So I showed you this before. So let's say that this box represents our store, our warehouse. Really, it's the merchandise inventory account. So at the beginning of the year, if we're a continuing business, sitting in the shelves of our store or warehouse is the beginning inventory, unsold items from last period. And then during the current period, we're purchasing more merchandise from our suppliers, maybe a wholesaler or a manufacturer. And what we call the things we buy is labeled purchases. Let me abbreviate that. So eventually we're going to have to pay our suppliers. Hopefully they give us some terms to postpone the payment. But if we pay off early, maybe we can get a purchase discount. So we're going to subtract that discount to get the net purchases that we put into our store. Or maybe if we're dissatisfied with that merchandise we bought, when we receive it, we inspect it. Maybe we didn't order it. We're going to ship it back to the supplier. Or maybe it's defective or the wrong size. We're going to ship it back. So that's called a return. Or if the supplier says, don't ship it back, we'll just reduce your sales price, your purchase price. That's called an allowance we get to subtract out. Or maybe we have to pay, we, the purchasing party, have to pay for the shipping costs. Okay, so that has to be added in. Yeah, shipping costs. Not subtracted, but added plus. So you total up all of this column here, the gross purchase price minus discounts for paying off early, minusing out merchandise re-return and allowances were given, adding in the shipping costs if we, the buyer, have to pay for it, not the seller now, yeah? This would be the net purchases that goes into our store, into our warehouse, adding it to the beginning inventory. That's the maximum now we can sell from our company because we don't have any more than that. The beginning inventory plus the net purchases. But of course, during the month or year, we're selling to our customers. And that's called cost of goods sold. It comes in our store at our costs. It goes out at our costs. But of course, we're going to charge our customers a higher price than what we bought it at. So that's called the sales price. And the difference between, well, let's make some adjustments here to the cost of goods sold. So let's say that our customer returns merchandise to us because they don't like what we sold them. So as a good seller, we want to keep good relationships with them. We're going to reduce the sales price called sales returns and allowances. Also, here's that merchandise coming back into our store at the original cost. And then maybe we give them an allowance. Keep the merchandise. We're going to give you an allowance, again, reducing this eventually the sales price. or giving them a discount if they pay off the bill early. Yeah, sales discount. Both of these are subtracted from the sales to get something called net sales, which we'll see in a few minutes. And then we subtract out the cost of goods sold to get a figure called gross profit that we've seen a few times already here in our video lecture. And from that gross profit, we subtract out operating expenses to eventually get the company's net income. Okay, so at the end of the year, here's the unsold merchandise sitting in our store. I know it's unsold because I can see it sitting in the shelves. Yeah, the shelves are not empty. Now, next period, this will move to be the beginning inventory. And here's next year's purchases adjusted for all of these items. Here's next year's sales. We remember now, every time we make a sale, you got to recall the revenue from the sale and the cost of the sale. So in theory, you should be able to figure out the gross profit from that one sale. Okay, let's move on and take a look at one of the major adjusting journal entries for a merchandising company. So we know we take out the merchandise, we got to reduce the inventory when we sell it. But sometimes merchandise just disappears. Maybe I shouldn't say disappear, but gets stolen either through shoplifting or employee pilfering, or just it just deteriorates over time. That's called shrinkage. And we won't really know that until we probably take a physical count. So near the end of the year or at the end of the year, we'll go through our store and start counting all the merchandise we have. We go into the back warehouse to make sure everything is there. And more times than not, we end up with less inventory than we think we should have. Now keep in mind, you always have this inventory account here, right? This is inventory, perpetually keeping track of how much you have. But then you're not going to keep track of things are stolen. In other words, the thief is not going to go up to the cashier and say, I want to steal this, so check this out for me. So your accounting records are going to be wrong. And the only way to get an accurate figure is to take a physical inventory, a physical count. And you don't do that too often because it's too time consuming. So usually you do that at least at the end of the year or close to the end of the year. And you compare that to what you say you have on your records. And then you need to update your records to the physical count you just took. So most times than not, you're going to reduce this inventory account. Here's the journal entry again. Here is the journal entry. Where is my journal entry? Reduce the inventory with a credit. And at the same time, you're going to increase the cost of goods sold expense. Even though it wasn't sold, we're going to be deducting this cost. Now, maybe for some companies, they want to debit another account just to keep track of the shrinkage, especially if there's a lot of theft loss. That's something you want to monitor. But here, the amount is relatively small, so we just adjust the cost of goods sold, deducting it here at the end of our accounting period. Remember, adjusting entries is what you do to update your records to be more accurate at the end of the period when you want to prepare a financial statement. Here it mentions that the true accounting rules may require you to kind of project how much sales discounts you're going to have and not wait until the customer pays you off, or how much returns allowances you think you're going to have even though it hasn't happened yet, but the sales already took place. We'll leave this for a more advanced accounting class to make these adjustments. So here, we're done trying to get ready for the next month or the next year. So we're going to have to do closing entries. And just like we had learned back in chapter 3, there are four closing entries. And closing entry number 1, we close out our revenue, which are normally recorded with credits. So here you can see a debit, and the offsetting credit goes into this temporary income summary account. Okay, that's number one. Number two is to close out all the expense accounts, which are normally debited. So here we credit for whatever is in those accounts. Now, including the big expense we're learning here in chapter 4 called cost of goods sold, here being closed or zeroed out with a credit. Also, the contra revenue accounts, these two we had learned in this chapter, were recorded with debits. Now we zero them out with credits. So we add up all of these credits and then we debit the total into that same income summary account that was used up here to close the revenue. So now, with closing entry number 1 and 2 journalized and posted, sitting in the income summary account should be the difference here of one figure called net income. And here is the net income now being closed out from the income summary account. Because we have more credits than debits here in the income summary after these two entries, we close out the credit balance with a debit to income summary. And the offset is now to update that retained earnings account. Since last year, we haven't touched this account until now, but updating it for the profits, net profit we made for the year, or in this case, the month. And then the last closing entry, number 4, is to close out any dividends that were distributed during the period. Dividends are typically recorded with debit. So here's the credit to zero it out. And the offset is now to reduce that retained earnings account with a debit. Okay, so 4 closing entries. Yeah, you journalize them like you see here and you post them to their respective ledger accounts. So now there should be nothing in the revenue account, nothing in these expense and contra revenue accounts. Income summary has been closed out in the first 3 closing entries here. Dividends have been closed out in the last closing entry. You're starting off with 0 balances in those accounts for the next period. So you don't mix up this period and next period's revenues and expenses and dividends. Let's take a look at the income statement for a merchandising company, a more detailed one called multi-step. So here, should I zoom in here? At the top of the income statement, of course, we have the name of the company, the type of financial statement, and in the case of an income statement, a period of time, all of December. And of course, at the very top is revenue. A revenue column is called sales. But now, what we subtract out right away from the revenue is the contra revenue accounts we had learned in this chapter 4, the sales discount and the returns and allowances for sales. We take a subtotal. Remember, really, this is like a debit amounts, yeah? Even though this is not really debit credit columns. These were recorded with debits and revenues recorded with credits. And when you combine them together, debit and credit, you always take the difference. Here's that figure called net sales we saw at the beginning of this chapter. Not gross sales up here, yes, sales, but net after discounts, after returns and allowances for our customers. And here is probably the biggest expense for our company, the cost of goods sold. Now, this net sales and cost of goods sold really are talking about the same merchandise, but net sales is how much we expect our customers to pay us. And for that same merchandise, here is what it cost us, cost of goods sold. Also keep in mind, this $230,400 is not what we bought of merchandise for December. It's what we had sold at our cost. The purchases is built into the inventory account. Yeah, this is what inventory that was sold, not there anymore. Okay, so we got gross profit, and then all the other expenses in this category called operating. That's broken down into 2 subgroups, selling and general and administrative. So everything it takes to sell that merchandise, we have accounts for that here. And then subtotal. And all the other expenses of running our business and subtotal. So total operating expenses subtracted from the gross profit gives us a figure called income from operations or operating income. And then we have some miscellaneous income and expenses to get our net income at the very bottom. Again, this is called a multi-step income statement, okay, a detailed income statement. Now we can collapse all the revenue and all the expenses together to make things shorter for a more quick view. Here called single step. So here's all the revenue and then grouped together subtotal. And here's all the expenses, including the cost of goods sold and subtotal. So in this single step, you don't see that gross profit figure. Yeah, net sales minus cost of goods sold. So just broad categories, revenue, expenses, and the same net income figure again. So just a quick view of that same company's income statement. And then not the whole balance sheet, but just the current asset section with the new merchandise inventory account, which now is going to be not just the ending of this period, but it's going to be the beginning for the next day, the next period. So we're going to sell it and turn it into accounts receivable and wait to collect that accounts receivable and turn that into cash. Okay, hopefully rather quickly, right? Current assets. So at the end of our chapters, of course, we have some ratios introduced to us to help us analyze the performance, the financial position of our companies. So the first one mentioned here is called asset test ratio. So it's a fraction where the denominator here at the bottom is current liabilities like we saw before in the calculation of a current ratio. But here now in the numerator is not current assets, but only part of that current assets called quick assets. Assets that can be converted relatively fast into cash or cash itself. Or here, short-term investments. You just call up your broker and tell sell and convert that into cash. Or here, waiting to collect money from your customers, receivables, and then eventually coming into cash, all divided by this current liabilities. So here it says, as a rule of thumb, you should have $1 of this numerator for every $1 of this denominator. Yeah, a 1-to-1 ratio. So looking at companies like Nike, their asset test ratio is pretty good, just more than 1-to-1. Same thing with Under Armour. But again, in the previous chapter, we saw when the numerator was all of the current assets called current ratio, it should be bigger, right? More current assets in the numerator for current ratio. And for not big companies like this, but probably medium or smaller size companies, a rule of thumb for current ratio is more like 2.5. Yeah, $2.50 of current assets for every $1 of current liabilities. Asset test ratio, especially if you have a good line of credit with your bank, 1-to-1 is okay. Yeah, 1-to-1. And then the other ratio mentioned for our chapter 4 is calculating something called gross margin. We know what that term means, right? Ratio, where the calculation of the numerator here is your gross profit. Sales or net sales minus cost of goods sold is your gross profit. And we divide it by the same net sales figure here. And typically it's some type of percentage. So this is kind of telling you for every dollar of sale, our company is making a profit of 44.7 cents. Okay, so if you buy something at $1 cost of goods sold and sell it for $2, yeah, you should be making a $1 over $2 or 50% gross margin. Most times over time, the gross margin doesn't change from year to year unless you have some major line product change. Then maybe there's a possible gross margin. Or you can get gross margins for different departments, different segments, different regions of your company and see who is doing better. And again, there's two calculations here, right? The sales price and the cost of goods sold. Sales price is the same here, yeah? So who's getting the bigger profit of the different products you sell or different competitors comparing each other? Bigger the better here. Okay, let's stop here. Nothing substitutes for you reading that chapter, yeah? in addition to watching these videos. Then go ahead and do your Learn Smart assignment, homework, restudy, and then take your chapter quiz. Okay, I'll talk to you later.